those disclosures. As I said, my name is Natalie Beckett, and I will be your moderator for this afternoon's free educational webinar. Today, we are happy to host Wendy Kirkland, and she is going to be putting on a presentation for you guys about options trading. Wendy, are you with us?
I'm here.
Hi, welcome. We're happy to have you today.
Thank you. I'm glad to be here.
Yeah, we're excited. We have a big group for you this afternoon. I think everyone's pumped to hear your presentation. So I am going to go ahead and pass over the reins to you, Wendy, so you can work on pulling up your presentation. While I do that, for those of you guys who are listening, if you have questions during Wendy's presentation, please feel free to put them in the Q&A or the chat box. I will relay those questions over to Wendy at the end of her presentation, time permitting. And Wendy, I always love, I think, how you got your start in this area is so interesting and so different from most people that you hear about. So if you don't mind letting everyone know here today how you kind of found your way in this industry, I think it's always it's really, insightful and a nice different way to come at it. So take it away, Wendy. All yours.
Thank you very much. Well, you took time out of your busy day to come spend some time with me. I hope to share some information that you're going to be able to use right away within your trading. And I commend you for, again, putting in the time and to expand your education. And this will help to become a more self-confident trader. My option trading, that for those of you who do not know me, I'm a full-time trader. I administer a number of advisories and I have written a number of books. Something called the P3 pattern, the P3 long and the P3.5 short. And a number of these books that are listed here incorporate that pattern within them, trading either different vehicles, different time frames, and so on. And that is part of what we will cover in today's session, and I will go into details about that as we move along. Mentioning, I came to trading by way of financial need. A lot of us maybe have parents that are involved in the stock market, or our education or profession brought us. My husband and I ran a gift shop in Asheville, North Carolina, and had 20 years or so into it. And Francis came through and our shop flooded, and it truly wiped us out. And we no more than started drying out and cleaned out all the mud and all of that. And Hurricane Ivan came through 2 weeks later and soaked everything again. We were really in dire circumstances. And a girlfriend took me out for my birthday to brighten things up a little bit. She mentioned that she'd taken a class in option trading and mentioned, I had no idea what she was even talking about, but I actually, we'd set aside for the electric bill. The electric was off anyway, so used it to pay for the classes, and it was just a really good fit for me. That was like sticking my toe in. I did a lot of studying on my own after that, where it became profitable, but an introduction into the market. And I think it gives me a different perspective a little bit, that I come at it as an artist rather than somebody that's coming in from a financial background. So the goal was to achieve financial independence and to get us out of the bind we were in, because we had everything tied up in that business. And eventually that desire grew to sharing and helping others achieve the same financial reward. This now for a long time through strategy books and writing weekly newsletters and coaching and advisory services. had you read disclaimers. I have one as well, just to read. Please do not trade with money you can't afford to lose. No matter what, there is always risk in trading. Cover a number of different found that helped me right from the get-go, and without any other whatever these do to trade better. One is timing your trades as far as the trading day. Next is selecting the best candidates. And then there is 3 essentials that will help you to have the very best successful trades. And one is to focus on equities that are overbought, equity bottom, have a trend reversal, and confirmed entry. And so we're going to take these one by one and go through them. It's very important to understand the various periods within the trading day. The first hour of the trading day, and it really isn't a 60-minute hour, it refers more to the initial trade, where trade orders that were placed overnight are filled, and there's this knee-jerk reaction to whatever is happening in the news and so on, and we've really witnessed that a lot lately, becomes instantly built into the market. And often during this first hour, it's called rookie hour or amateur hour. And this is the time when new traders see that there's going to be a morning move, and they get all excited about a trade, and they jump in quickly, have their order filled, and then as the market fills these orders, then it settles back. It pulls back a little bit, and their premium drops. Now, sometimes it can drop as much that it would then hit their stop, and if they've placed one, or they get very nervous and decide to close the trade. Now, this doesn't mean that the market might not climb back up and move beyond that order fill amount, but it does mean that the new trader may have been able to buy at a lesser premium, and as it then moves past that fill amount, they would already have gained a profit. And again, this isn't a 60-minute hour. It's called professional hour. And this is where professional traders and the money managers and so on often take profit or make purchases for the next day. From between 11:45 and 2:15 can be considered the lunch hour. And during this time period, the stocks often will settle back as traders break to eat, and then they return for the afternoon session, where between 10:15 to noon. And the afternoon session is between, say, 1:30, 1:45 to 4 o'clock. And again, the minutes are not hard and fast and fixed periods, but once you start paying attention, you'll be able to bring up an intraday chart, let's say a 30-minute chart, and see these reversals take place, whether it's the morning reversal or lunch period or at the end of the day. The timing really has nothing to do whether the stocks are likely to be up or down for the day, that it's more to be a transition during these periods of the day. They may go from up to down or down to up or flat, and there really isn't any usual, but we're going to look at a chart where you're going to be able to, and once you start paying attention, you will see that it happens often. This that has low bottom is the first candle of the day, and this is during that period. This is a 30-minute chart, so this is the first half-hour candle from 9:30 to 10. So where it actually closed is this little middle line here. Opened close to this dotted line here, went all the way up, and then settled back where it closed. So if a trader had placed an order, they very well might have been filled up here somewhere around 71.75, and yet by 10 o'clock when the candle opened, it was actually 75 cents less, filled much lower, and then it took the next hour or so for it to get back up to that area where they would have been filled. And by the time it hit lunch, they would have very, very little profit. And then it settles back, and in the afternoon session, it actually dropped way back here to the open and kind of flattened out. And by the end of the day, had closed during the day. So a much better opening here on the second candle, have profited all the way up here to the lunch period, and then maybe have closed their trade and a put trade in the afternoon, riding it back down again. So this shows the big swings that can happen on open, and you're much better off waiting to enter your trade after that rookie period. Is to consistent big moves. And an easy way to do that is to apply an indicator that is called the average true range, or ATR, and to your chart. And what you want to do is to apply it to a daily chart, because what you're interested in is what their average daily move is. So this is Alibaba, and it's down here where the indicator is lining up is about $6.55. If price, it's $1.88, and we're going to be looking for an average of a 2% move per day, and so that's $3.76. And so you can just quickly estimate this. You look at the price, multiply it by 2 mentally, and come up with move would be, and then look for the ATR to be more than that. This would be a great candidate. And so from that, you start building a chart list. And along the way, I discovered that a 2.5 to say 4% move in price will often equal a double in a weekly option premium if it moves in your direction than a 2.5% or so. Or a 3 to 5% move in price will equal a double in a monthly option premium. So it's very easy to create a list of stocks that have a move. In this case, this is NVIDIA. A 2% move on this chart was $4.82, and its ATR was $10. So that would make, again, a great candidate, because on average, it moves maybe 4% a day. And so if you get the direction right, you can often have a double within a day's trade. Move on now to the 3 earlier. One is to be overbought or oversold, to confirm a trend reversal, and then to have a confirmed trade entry signal. And I'm going to show you how to get all 3 of these. So we're taking a chart, and we're going to add an indicator. This is the CCI, and this just like you would RSI or Williams %R. It's an oscillator that swings from oversold to overbought. It's very clear. It's a, like I said, it's a picture. It paints a picture for you. Down here where you have this brown, I call them fins, like fish fins, shark fins, oversold. The green area is overbought. And so what you're going to be looking for is for a trade long to be over and then to cross up over the minus 100 line. And that can be as an entry period along with the other things that we're going to talk about. And from there, because it's an oscillator, it swings from being overbought down to oversold, back up to overbought again. And so in this case, you can see that how it changed, crossed over the minus 100, came up here, rose, and then stayed overbought for an almost 2-month period of time as it rose. And then when it started heading down again, that is when it's working its way back to being oversold. And it is a very visual and simple to read. You can use it in various time frames, that whether you're looking at daily charts or 60 or 30, it's the same. Again, it goes from overbought, crosses down the one here, then it drops and gets down here to being over, start working its way back up again. All right, element now is a trend reversal. So we've gone from being overbought, oversold. We're going to be looking for a trend reversal from that area. So in addition to being recently oversold and moving up over the 100 line, we're applying a PPO indicator per oscillator. And the price moves in the black line crossing over the red line. So here you can see that it crossed up. We have the CCI crossing up over minus 100, and price is rising. When it has a really full cross down with some space between the lines here is about the point where an exit would be. And you can take this back and earlier in the chart and see where you had a cross down here of the PPO, price dropped, cross back up, price went up. Here in the middle, it will cross down again, and price period we already covered. So that is the second. Another bottom, so that you can see here you had recently crossed up over the minus 100, had the PPO cross up, put up part, and you can see that it just, and then it stayed in this overbought area for a good while, a number of days. All right, so earlier I mentioned I am known for is something called the P3 pattern or P3 squeeze. And it brings all of these elements that I'm talking about kind of together. This silly little drawing that is here, we are going to be looking for. And I'm going to, in a second, when we flip to a chart, your eyes will pick it out instantly. That the PPO and this lower indicator is an ADX. They have nothing to do with each other. They are totally different indicators that have um, for how they're calculated and put together. And yet, early in my trading career, I discovered that when down like this and they come close together, and the word close is subjective. We'll see some that when you have those lines come together, almost like the area in a guitar where they squish in together in that middle area and then start to push apart, price, it just does. And this concept grew so that I studied and studied and studied these patterns, looking at thousands of charts, and realized that this pattern actually goes through stages. And that's what I teach, is the P3 pattern, and the stages that it goes through tells you when to get into a trade, when you could add to a trade, when it has hit a stop, when you could relax a little bit because it's just going to keep going, and then when to exit. All right, so let's look at a chart and begin to see these. That there, right there is an area where the lines, the PPO and the ADX that we've added. ADX is average directional index, and so I've added this other indicator beneath the PPO. We have the CCI, PPO, ADX. You can see the lines have, when the PPO crosses up, the price is going to go in that direction, and the ADX kind of push away from each other, price is going to go up. PPO crosses up each other, price is going to go up. I can see that I actually have an exit here and I have an exit there. This should be entry. So that would be your entry period, and you can see as it crosses up over the minus 100, and then it moves on up. Again, there is stages so that you can really, really define this. Here's one. I didn't circle it this time. So I, again, have no doubt that you can pick out this area right here where the lines dip together again. And this is the P3 squeeze as the PPO crosses up and from each other, price is going to go up. Now it's important and detail all of this, all of the stages, and it's the books are kind of written like you and I are talking across the kitchen table. But you see this little area right here where there is this peak here, and there's a dip that happened a day or so ahead of that. That is not a P3 squeeze. That is not an official P3 squeeze pattern. There's criteria, I guess you would say, that it has to meet to know that it's lined up over the top of each other. We'll look at some more here. This is some, and to let you see that it is up and over, and the lines push away, there is going to be a little bit of an upward move. And you can see it happened again, a little upward move right there. On this third one, a little upward move. But all three of these were kind of false starts. They got going and never really followed through with the other stages that needed to happen. I call this re-squeezing. They got going and they ended up re-squeezing. It wasn't until down here on February 9th that the PPO crossed up the ladder, that then price really had the strength and the momentum to upward and forward and to be a really successful trade. So this is not a rare occurrence. Here again is a nice tight P3 pattern. Got started, price moved up, but it did not keep going, flowing through all the patterns. It flattened out and then it pulled back, created another. Again, you can see here it is oversold, and then it crosses back over the minus 100 line. The lines, PPO crosses back up, the lines push away from each other, and price then flows and works its way going through all of the very best plays have confirmation entry signals, and we've touched on some of them as far as the CCI is concerned. There is one other indicator that can be added to this that helps kind of weed out. Again, this is Visa. We had the PPO cross where lines went up and had the PPO cross back down. It didn't have the strength or the momentum to really drive forward and keep that momentum going. Formed another P3 squeeze. Again, the PPO crossed up, lines pushed away, and then that really took it forward and up close to out to you. Work on any time frame that you can be looking at, a weekly chart, a daily chart, 60-minute, 30-minute, all the way down to 1 or 2 minutes. Not everyone can make decisions fast enough to trade the super short-term charts, but as far as the pattern formations, it works out exactly the same. And again, I think that's the reason, because I'm an artist and I see patterns and designs slightly differently than all about the numbers and so on, that these two indicators, the PPO and the ADX, they have nothing to do with each other. It just is one of those things where I noticed that most of my winning trades have this pattern form, and that as I studied it, I started seeing others, other stages of the pattern. So again, you have the PPO cross up here, the lines pushed away, and price is going to go up, but it can only go so far based on the PPO alone. And then it crossed back down and dropped, then back up again a couple days later, and then had a really, really nice move upward. This was John Deere. Best trades, as mentioned, have confirmation signals. And this is all very easy to put on the chart, very easy to learn, verify and incorporate no matter what you're trading. I trade options, and the reason that I trade options is because you can buy of a premium that is a small fraction of stock. It's like being able to control the stock with just a down payment. An example would be like if you put a option on a building and you said, I'm going to maybe buy this building in 6 months. And during that 6-month period, the building escalated in value, that went down the way that was going to be helpful, or more, a new road in front of it that was going to bring traffic. And so you haven't bought the building yet, but you have an option to buy it, in a sense like first refusal. And the benefit of this increase in its value, and you are in a position then, say somebody comes along and says, gosh, I really want to buy that building because you have first refusal on it, you can sit and sell it to them. You would buy it and then sell it to them for that higher price and keep the difference, even though you really never took ownership. Benefit of options. But what I have shown you today, as far as these patterns and the squeeze pattern and the way that they play out, you can use it for anything. You could apply these patterns. I have friends that trade Forex. You can use it to buy stock if that is what you're buying. If market or whatever, you can because they tell you where it's going next. All right, let's continue here. Again, the patterns are not a rare occurrence. We've kind of already established that. It's not like it just happens once in a while, and they happen in any time frame. When the PPO crosses up, go up. So, P3 short pattern. Is more difficult for some traders to wrap their brain. This is the complete opposite or the reverse of, and so the creation or the formation of the pattern is where the lines of the ADX and the PPO run parallel to each other. We have the CCI has in and is dropping down below 100. That shows that it's overbought, has too far, too fast, and needs to pull back a little bit to rest. And so we have together, we have them running parallel, and then when we have the PPO cross down and the line together and price drops. In this case, you would have had a entry up here on the 24th and probably exited somewhere down here on the 26th. Bit tough to see the running parallel because the parallel is sideways rather than on a slope upward. Cross down, and it's gone now from being overbought to oversold. You can see a big, huge drop. It's kind of pushed away. This was a hard and fast move. We look at the second one here. The back down again and pushed away from each other as it continued to drop further and further. Then we can see here, and I'm just going to have, after this big drop, you have the PPO crossing back up again and pushing away. And this then would be the beginning of a new P3 squeeze. So it goes flow together. You have a P3.5, and then you have that drop forms a new P3, and the P3 playing out, that forms a new P3.5, and it the patterns flow back and forth. Well, we've here. My contact information, you can get more information at Wendy Kirkland